Hey, it's Max from UNFTR here with the macro take exclusively for the MeidasTouch network. And I got to say, I'm eating a little bit of crow here today because looking at my little cheat sheet here, I got gas is down, stocks way up, inflation is down, and jobs are up. So looks like I owe this administration a little bit of an... hang tight.
Stocks cratering this morning as President Trump says there will be no deal to end this war with Iran without unconditional surrender. That's sending oil prices soaring. Wall Street also rocked by the February's jobs report just in, which shows the U.S. lost 92,000 jobs last month, way off analysts' expectations. Unemployment also ticked up to 4.4%.
Yeah, everything is hitting the fan all at once because we're shifting from a quiet recession to a wartime recession. Basically, different shades of darkness. And we're going to go through all of it on today's Macro Take. Later on, we're going to do a deeper dive on the job market because the most recent private market figures looked like they were going to be pretty robust. But then we got a catastrophic job report that didn't just miss consensus targets, it showed a massive decline in U.S. jobs. Now, to help us set the table to explain this phenomenon, we'll hear from Kevin, I didn't get the Fed job, so I'm just going to be snarky and dismissive from now on, Hassett.
Well, we had the crazy weather in February. The worst of it was actually outside of the survey week, but there was a lot of lingering junk, as you might recall, with the ice that was everywhere. We had some strikes on the West Coast that knocked off between 30 and 40,000 jobs. And so I think that on net, it's almost like a wash number.
I see. So it was a few strikes on the West Coast and snow that just made it a wash. It's not because of mass deportation or supply chain chaos and inflation from tariffs. It's not because of the loss of healthcare coverage or tax cuts for the wealthy, historic consumer debt, asset inflation pricing people out of homes to the point where the average age of the first-time home buyer is 45 years old, new stringent work requirements for federal aid even if you're sick, disabled, or a primary caretaker, elimination of disaster funding for states that experience devastating effects of climate change, and an economy where 10% of the population is now responsible for 50% of consumer spending. No. It's snow. We're going to close out this episode with a look at what the hell is going on in the labor market. But before we do that, let's look at a few of the moving parts in the economy that are rapidly shifting beneath our feet. Let's start off with something that we've been tracking over the last year, and that's the repo market. So this is the emergency brake that the Fed employs when there are either rate pressures or liquidity issues in the financial markets. And the reason I want to start here is because the macro level data that we're going to explore is what's above the surface. And no matter how hard this administration tries to spin it, you have eyes, ears, and wallets that tell the ultimate truth. But it's what's below the surface that's harder to parse. Now, in our last Meidas episode that I'll link in the notes, we did a deep dive into the private credit markets. And this space continues to show major cracks to the point where it's gone beyond one-off issues. There are serious issues in the plumbing of the financial system. And one of the ways that we can get a sense of the stress, even though it's still impossible to pinpoint due to the shadowy nature of how these markets behave, is whether overnight settlements are occurring within the Fed's target interest rate range. So in plain English, there are financial intermediaries that provide capital in the overnight markets to make sure that transactions between counterparties settle without friction or rates exploding. It's a multi-trillion-dollar market where rates are set independently by counterparties and intermediaries that are laying out the cash for a very small fee that does add up to be a big business. But when one party either A, doesn't necessarily have the cash on hand to settle these out, which is rare, or B, senses that there's a bit too much risk at play, which is typically the case outside of emergencies at least, then the Fed steps in to assume some of the transactions at a fixed rate below what the market is offering. It's a backstop or an emergency brake, as I said, and it provides stability in these lending markets. So what you see here are instances already this year that the Fed has had to step in. In years prior, it wasn't uncommon to see the Fed step in at, let's say, quarter end or year end, because that's when transaction volumes are at their highest. But we've seen a trend in this second Trump term of the Fed stepping in repeatedly in non-quarter or non-year-end periods to supply liquidity. So we saw it a week ago where they took on $30 billion in securities overnight, and again this week when they took on $9 billion at the start of the war in Iran. And I'm starting here to demonstrate that the economy below that surface is already a ticking time bomb, and it's been getting louder and louder over the many months since Trump announced his Liberation Day tariffs. Coincidence? I think not. I surfaced this to show you that when you overlay frontline economic issues like labor market weakness and inflation, it means that these issues are now beginning to bleed out all over the place. We've lived in a high liquidity and low interest rate environment, relatively speaking, for the better part of 15 years, and the broader markets in the economy have therefore been able to withstand isolated shocks like tariffs or the prospect of job-killing AI, supply chain inflation, and the like, for quite some time, even if it's been at the expense of the consumer and the middle and working classes. And now we've thrown everything into a blender with the start of a war in Iran. A war that was started for no apparent reason for American security interests and was certain to rip apart the one thing that had been holding the Trump economy together: low energy prices. Even though that was a sign of recessionary trends, it was the one thing that was maintaining inflation where it was. And this has been a consistent theme across the board. Inflation hasn't gone anywhere, but Trump was able to hide behind flattened figures because energy was tanking and dragging the whole inflation index down. Now that's all gone away, which brings us to the next data point. Crude oil has skyrocketed well beyond any projections because no one had war with Iran on their bingo cards this year. In fact, we were in a situation of oversupply and diminishing demand already, leading to a scenario called contango when supply and demand expectations were misaligned. Everyone pretty much understands now that this is because Iran has essentially choked the supply of Middle Eastern and Asian oil by closing the Strait of Hormuz. Now that explains Brent, but what's interesting is that the oversupply has also inflated WTI prices, which typically fall 5% below Brent. So as you see here, WTI prices have caught up to Brent, and the two are now moving in tandem and moving higher by the day. So the key question for the real economy isn't the spike itself, it's going to be duration. Because a short-lived move like a couple of weeks mostly shows up as a noisy bump in the monthly energy numbers and a quick, painful reminder at the pump, but it doesn't fundamentally change the trajectory of core goods inflation. If, however, crude stays elevated for several months, higher energy costs begin to seep into freight, petrochemicals, plastics, and the entire manufactured goods supply chain. Drivers are going to see the first effects of this almost immediately, and you probably have. Retail gasoline prices respond typically within days, because stations don't wait for a full macro narrative to form before adjusting the sign out front. The statistical agencies, by contrast, will record them in stages. First in headline inflation through the energy component, and only gradually, if the shock persists, in the broader goods categories. That's why central banks will treat this as a classic signal versus noise problem, a temporary oil shock that lifts headline inflation but leaves core inflation relatively contained, and that's an argument for patience at the Fed. A long-lasting conflict-driven premium that keeps crude high in the summer months, which is driving season, and starts to lift underlying goods prices would complicate the deflationary story and make rate cut timing a lot more contentious. Either way, it'll give the Fed board fits trying to untangle the so-called signal from the noise, as they like to say. While we're on the topic, let's stay with inflation measures because there was another report that came out this week called the Import Price Index. So this is for January, so all bets are off on how this is going to look in the coming months, mind you. This is the foundation of inflation, and the report shows that overall import prices edged up 0.2% month over month, but it was only held in check by a drop in fuel prices. Again, this has been the fig leaf for the Trump economy. But non-fuel imports surged 0.5% monthly and 1.2% annually, signaling persistent pressures from manufactured to finished goods. So when you take this in conjunction with the recent producer price index jump, and you factor what's coming with increased fuel and energy prices, it means that inflation is ready to pounce on an unsuspecting consumer. And what's insane about the timing of this war is that it guarantees inflation. And he did it at the exact same time that people in the country are supposed to start receiving their refunds. And if you recall, this was the centerpiece that Scott Bessent and Kevin Hassett and Donald Trump were all saying was going to somehow jumpstart the economy in 2026. This was literally their biggest talking point for the last year. Just wait until those tax refunds. No tax on tips, even if we destroyed tourism, resulting in fewer tips in hospitality. No tax on overtime, even if it really only applied to a third of overtime, and now we have less overtime because we're working fewer hours because we're in a fucking recession. But don't worry, when you get those refunds this year, you're going to be so rich, even if the refunds are projected to be lower than the ones that we got in 2024 under Joe Biden. And now with inflation coming roaring back, even those are going to be gone. You know, I'm almost starting to get the sense that these guys aren't talking to each other in the administration, and they might not know what's going on. Anywho, one last thing before we talk about jobs, because it's an indication of how chaotic things are. This is the US dollar. In recent days, the dollar has been strengthening. Remember that one of the things that Donald managed to accomplish was the devaluation of the dollar, which reduced the purchasing power of Americans. Well, now it's beginning to strengthen, which is a curious but ultimately positive sign, and here's why. When a country pivots toward a war economy, markets redraw the map of what counts as safe. In this conflict, the first instinct has been textbook. Money is sprinting into the dollar and into dollar-denominated assets like treasuries, pushing the greenback to its strongest level in weeks because global investors are looking for a deep, liquid bunker. Along the curve, front-end yields have come down from their highs, but they still sit in the mid-threes, while the 10-year hangs a bit over 4%, high enough that you get paid to wait in dollar paper, but not so high that it screams panic. And that's the bond market's way of saying, we still believe in the dollar as the backbone of a wartime financial order, even as we quietly price in bigger deficits and a more militarized fiscal future. But out in risk land, the picture is way more fractured. See, equities are rolling over as investors mark down growth and brace for the possibility that the Fed delays rate cuts, and that if oil keeps headline inflation elevated, then things are going to be pretty dicey. So it is a positive sign, even though we have become the scourge of the world, that the global investor class at least still sees the dollar as safe haven. Now, that being said, at the same time, Bitcoin rose a bit on the news of war, which is totally counterintuitive to what I just said because it's entirely a risk asset. Well, proof of where the president's priorities truly lie, Donald took to Truth Social this week to accuse the big banks of sabotaging his crypto agenda and to demand that Congress pass the Clarity Act, which is the flagship crypto market structure bill, ASAP, to keep the U.S., the world's crypto capital. So you've got this split screen here. You've got the classic flight to safety into dollars and treasuries on the one side, and on the other side, a speculative bet that in the world of sanctions and weaponized finance and war spending, politically blessed crypto might be the high beta hedge against the very systems that investors are hiding in. It's honestly one of the more cynical and disgusting things that one can imagine against the backdrop of an illegal and costly war that started with the bombing of an elementary girls' school in Manab, killing over 100 children. And I wish this came as a shock and a surprise, but the depravity of this administration knows no boundaries. Now, with that, let's finish with the headline story to explain what the hell is going on in the jobs market. So the month actually kicked off with what looked like positive news on the surface, from private payroll figures at least.
ADP private payroll data is out, showing a jump in February. Private employment was up 63,000. That beat the street estimate of 48,000 for the best month for job gains since July of last year. Education and health services, along with construction, led the growth. The biggest laggards were professional and business services and manufacturing.
But the devil is always in the details. So there are two narratives that are hiding below the headline figures that are very uncomfortable. The first is where the gains can be found, as Becky just alluded to. Now, we've covered this before. We continue to see gains in healthcare, which isn't a net GDP positive indicator, because it's a reflection of our aging population and the need for sick care. It's okay to have this kind of activity if you're reinforcing gains in the entry-level market for college grads, let's say, or the manufacturing sector and other activities that'll produce gains where the spending comes back into the real economy. But in this case, you're seeing wealth flow from an aging population into the private healthcare sector almost exclusively. And as far as those construction gains, we've unpacked that pretty exclusively in a prior video as well. And it shows that the gains are in the non-residential sector, with materials and expertise revealing that it's primarily related to data center construction. It's not for big infrastructure projects that provide a wide benefit or even housing to help with our supply issue. Now, the other narrative is with respect to size. What the private gains show is a kind of barbell effect where you see growth in small and large businesses. Now, at the top, you're seeing the effect of basically monopoly and purchasing power. Again, it's okay to have that kind of growth if there's even distribution throughout because it correlates with wages. The top gainers are usually higher paying salaried jobs at the big companies, but the growth at the smaller end, without similar gains in the middle, means that job seekers are settling for lower wage jobs at smaller enterprises. And this is borne out in the wage data that shows that we have the lowest growth in both job switchers and job stayers. So overall, this continues to be a sign of a sick labor market, something that the Fed is keenly aware of, and why they're loath to pursue aggressive policies that would cause undue harm to the labor market. And that was the good news, which of course was followed up with the bad news.
The U.S. economy unexpectedly lost 92,000 jobs in February. The unemployment rate inched higher to 4.4%.
The job losses were so far off the consensus that it shook both the administration and the markets. Of course, as you heard from Kevin Hassett, they're doing their level best to downplay it as an isolated month. But remember, this was on the heels of the historic revision to 2025 data that showed the full year was the lowest job growth on record in more than 2 decades. Rebuilding the labor market is going to be a tall, tall order. And one last note to leave on to reinforce this broader picture. You hear a lot about the unemployment rate and how it ticked up to 4.4, which isn't great, but it's not a disaster. The problem with this number is that it excludes people who've dropped out and are chronically unemployed, but it picks up those who are chronically underemployed, like gig workers, and anyone who responds to a survey that they've worked an hour, a paid hour, in the 4 weeks leading up to the report. Now, the real key here is the population and the trend line. So you can see that the labor force and the inactive labor force are growing in tandem. Mass deportation has led to net outflows of the population, which means the sample set of those in the prime age demographic at the top is shrinking. So in relative terms, the figure keeps increasing, which is why labor economists can say, oh, the market's healthy. But if you look right below it at the total labor participation, which is anyone above the age of 18 who's not enrolled in college or the military, the figure is now declining in a real way. So the takeaway here is that every month there are fewer and fewer of us working, while wages are also stagnating, so our purchasing power continues to decline. That's why every metric surrounding the labor market makes the archaic way that we choose to track unemployment so misleading. And as if the red flashing lights in the cockpit weren't enough to wake up this administration, they decided to start a war that promises to deepen the economic pain of everyone in this country, unless you're a shareholder of a military contractor. From the quiet Trump recession to the full-blown Trump recession, so much winning. For the MeidasTouch Network, I'm Max from UNFTR. Resources for today's episodes are in the description, and make sure to subscribe to the free weekly newsletter at UNFTR.com. You can find me on Blue Sky and on YouTube at UNFTR as well. This has been the Macro Take, exclusively for the MeidasTouch.
Want to stay plugged in? Become a subscriber to our Substack at MeidasPlus.com. You'll get daily recaps from Ron Filipkowski, ad-free episodes of our podcast, and more exclusive content only available at MeidasPlus.com.